Hey, what's up everybody? It's Chana, your money babe. We all see those images of people making a killing in the stock market. Lambos, mansions, early retirement. And it's easy to think it's just a matter of picking the right stock at the right time. But the truth is, most new investors actually lose money when they first start out. Why? Because they make some really common but avoidable mistakes. That's why in this video, I'm breaking down the 6 biggest mistakes I see beginners making, and more importantly, how you can avoid them to start building wealth the right way. By learning from my past mistakes, and by listening to the advice I'm going to share with you today, you can set yourself up for success and start seeing those green numbers in your portfolio. Let's jump in. This is probably the biggest mistake I see new investors make, and it's totally understandable. You see a hot stock trending on social media, everyone's talking about it, your friend from college tells you it's about to blow up, so you jump in head first without really understanding what you're buying. The problem is, investing based purely on hype or speculation is just gambling. You might get lucky in the short term, but long term, you need to invest in companies with strong fundamentals. Before you buy any stock, take the time to really understand the business. What do they actually do? How much revenue are they generating? What's their debt situation? Are they profitable? Look at their past performance, but more importantly, try to understand their future growth potential. You can find all of this information online and on financial websites like Yahoo Finance, Google Finance, or Bloomberg. Remember, buying a stock means buying a piece of a business. So, be a smart investor, do your research, and make sure you're investing in companies that are built to last. You finally take the plunge and buy your first stock. A few days later, it's up 10%. You're feeling like a genius, like Warren Buffett himself. Then, the market takes a dip, and your stock plummets 15%. Now you're panicking, right? You sell everything, locking in your losses, and vow to never invest again. This, my friends, is emotional investing, and it's the quickest way to sabotage your financial future. Successful investors understand that the market is like a roller coaster. There will be ups and downs, and that's completely normal. The key is to not let your emotions dictate your investment decisions. Don't get greedy when the market is up, and don't panic when it's down. Remember, you only lose money if you sell at a loss. Develop a long-term mindset. Remember why you invested in the first place, and trust in the power of compound growth. Over time, your patience and discipline will be rewarded. Imagine you put all your money into one single stock. Maybe it's a company you love, or you're convinced it's the next Amazon. But then, disaster strikes. The company faces unexpected challenges, their stock plummets, and you lose a significant chunk of your investment. This is why diversification is absolutely crucial. Don't put all your eggs in one basket. Instead, spread your investments across different stocks, different industries, and even different asset classes like real estate or bonds. A well-diversified portfolio helps mitigate risk. If one investment performs poorly, others can cushion the blow. Think of it like a safety net for your money. One of the easiest ways to diversify is by investing in ETFs or exchange-traded funds. ETFs are like baskets of stocks that track a specific index like the S&P 500 or the Nasdaq. By investing in an ETF, you're instantly diversifying your portfolio across hundreds of different companies with just one purchase. We've all seen the headlines. This stock went up 200% overnight, turned $1,000 into $10,000 in a week with this one weird trick. It's tempting to get caught up in the hype and start chasing those quick profits. But here's the hard truth. Real wealth is built over time, not overnight. Trying to time the market or jump in and out of stocks quickly is incredibly risky and often leads to losses, especially for beginners. Instead of chasing quick profits, focus on building a portfolio of solid, long-term investments in companies with strong fundamentals and a proven track record of growth. Remember, slow and steady wins the race. Stick to your investment strategy, focus on the long term, and you'll be amazed at the results you can achieve. Okay, let's talk about something that nobody really enjoys, but is super important: fees and taxes. It's easy to overlook these costs when you're focused on potential profits, but they can really eat into your returns over time. First up, brokerage fees. Every time you buy or sell a stock, you'll likely incur transaction fees or commissions. These fees can vary widely depending on your brokerage, so it's crucial to shop around and compare costs before you open an account. Consider using a commission-free brokerage, especially if you're just starting out and making smaller trades. These brokerages don't charge you a fee for each trade, which can save you a lot of money in the long run. Now let's talk about taxes. Yes, you have to pay taxes on your investment profits. The good news is, If you hold your investments for longer than a year, you'll qualify for lower long-term capital gains tax rates, which can save you a significant amount of money come tax time. The key takeaway here is to be mindful of fees and taxes. Choose your brokerage wisely. Consider holding your investments for the long term to minimize taxes and factor in these costs when calculating your potential returns. Having an exit strategy is just as important as having an entry strategy. Many beginners get so caught up in finding the right time to buy that they completely forget about when they plan to sell. Holding on to a stock forever might seem like a good idea, but what happens if the company's fundamentals change, their growth stalls, or something unexpected happens in the market? You need to know when to cut your losses or take profits off the table. Before you buy any stock, ask yourself, what are my goals for this investment? How long am I willing to hold it? At what price will I sell if it goes up? At what price will I cut my losses if it goes down? One helpful tool you can use is a stop-loss order. This is an order you can place with your brokerage to automatically sell your stock if it falls below a certain price. By having a clear exit strategy, you'll be better prepared to navigate the market's ups and downs and come out ahead in the long run. There you have it, guys. Those are 6 of the most common stock buying mistakes I see beginners make. The good news is, now that you're aware of them, you're already one step ahead. Remember, investing is a continuous learning process. We all make mistakes along the way, but the key is to learn from them and keep improving. If you found this video helpful, do me a favor and hit that like button. Subscribe to Money Babe for more investing tips and tricks. And let me know in the comments down below, what's one mistake you've made or almost made while investing? I read every single comment and I can't wait to hear from you. Until next time, keep crushing it. Now that you know these mistakes, you're already ahead of most beginners. Investing is a journey. Mistakes will happen, but the key is learning and improving. If you found this helpful, don't forget to like, comment, and subscribe to Money Babe for more investing tips. Tell me in the comments, what's one mistake you've made or almost made while investing? Invest smart, grow wealth.